You'll have many options when it comes to choosing a mortgage, and we're here to help you find the mortgage products that best match your needs. But first, let's familiarize ourselves with the following terms you'll be hearing a lot about throughout the entire mortgage approval process. The amortization period. This is the length of time it will take to pay off your mortgage. The amortization period can vary, but it's usually 25 or 30 years. What amortization period is best for you? There are benefits and restrictions with each. For example, if you're putting less than 20% down on a home, the maximum amortization allowed would be 25 years. But if you can afford to put more than 20% down, you may be able to obtain a 30-year amortization, which would help reduce your monthly payment amount. Another word you should know about is the term. This is the length of time that the options and interest rate you choose are in effect. Your mortgage term can be anywhere from 6 months to 10 years. Traditionally, Canadians will opt for a 5-year mortgage, but at Pineapple, we'll help align this with your mid to long-term goals. When the term is coming to an end, you can renegotiate your mortgage and choose the same or different options. This is called a renewal, and there's a whole other video just for that. The great thing about Pineapple, for the life of your mortgage, you're not alone, so we'll be right there when this time comes to help you make the best decision for you. Something else you'll frequently hear about is the payment schedule. This is how often you make your mortgage payments. It can be set up weekly, every 2 weeks, or once a month. Together we'll find the right schedule that works for you, but what's important to remember here is that your payment frequency could help you pay off your mortgage faster. Now we're also going to go over the 2 types of interest rates available. A fixed rate is when your mortgage interest rate doesn't change for the term of the mortgage. A variable rate is when your mortgage interest rate fluctuates with market rates. So, for example, if you have a fixed rate of 2% and a 5-year term, your payment will remain the same for that mortgage term. If you have a variable rate, on the other hand, your mortgage payment could be less 1 month and then more the next. As you can imagine, both options come with their own benefits and ways that they can help homebuyers like you. To ensure you pick the right one, your Pineapple agent will help you decide based on your financial condition and tolerance to risk. Next, let's discuss the difference between an open and closed mortgage. Most mortgages today are partially open, but what does that mean? Well, a fully open mortgage allows you to pay off your mortgage in full or in part at any time and without any penalties. A closed mortgage offers limited or no options to pay off your mortgage early, in full or in part, but it usually has a lower interest rate. So a partially open mortgage will allow you to pay off your mortgage in full or part early, but there will be a penalty to do so. I think you're getting the hang of this. Now, let's not forget about the 3 types of loans available to you. These are insured, insurable, and uninsurable mortgage loans. An insurable loan simply means that the loan meets the requirements to be insured, but does not require a mortgage loan insurance. An example of this would be a home worth $800,000 and the borrower has a down payment of 25%. These types of loans have better rates than uninsurable loans. An uninsurable loan does not meet the requirement of the default loan insurer. These types of loans require 20% down payment and will usually have higher interest rates. An example of an uninsurable loan will be a rental property or a home priced over $1 million or a mortgage refinance. Mortgage loans also come with 2 options. There's the prepayment option. This gives you the ability to make extra payments, increase your payments, or pay off your mortgage early without incurring a penalty. Why does this matter? Well, not all lenders will let you pay off your mortgage faster, and some have very high penalties if you need to break your mortgage early. It's our job as your dedicated mortgage broker to get you into a mortgage that is right for you, but it's also our goal to get you out of the mortgage when it makes sense to do so. Another option you need to know about is the portability option. This allows you to transfer or switch your mortgage to another home with little or no penalty when you sell your existing home. In this case, the mortgage loan insurance can also be transferred to the new home, saving you thousands of dollars in future expenses if your goals are to move in the near future. Now that you better understand some of the mortgage terms you will hear about during your home buying journey, it will be easier for us to make the best decision together. Once your home has been accepted, your Pineapple team is ready to submit your application to the right lender for the right product based on your needs. Remember, your Pineapple team is always here throughout this entire process, and we're so happy to answer any questions you have along the way. You just gotta call.